In a world where we trust banks with our life savings, a shocking scenario unfolds. What if one day all banks declared bankruptcy? Could your money simply vanish? Bank failures and their responses. But what exactly a bank failure means? There are two key terms here: insolvency and illiquidity. Insolvency occurs when a bank's liabilities exceed its assets. It simply doesn't have enough to cover what it owes. Illiquidity, meanwhile, is about timing. A bank may have assets, but it can't access them quickly enough to meet immediate cash demands from depositors or creditors. Bank failures aren't just theoretical scenarios, they're real events with profound impacts. For instance, the collapse of Lehman Brothers in 2008 was a pivotal moment, marking one of the largest bankruptcies in history and triggering a global financial crisis. Fast forward to 2023, and we saw similar distress signals with the failure of Silicon Valley Bank, which underscored potential risks even in tech-driven financial models. What's been done to prevent these catastrophic events? Post-2008, regulatory frameworks were significantly tightened. In the United States, the Dodd-Frank Act was introduced to increase transparency, enhance bank accountability, and ensure that banks maintain sufficient capital to handle economic downturns. This act also established annual stress tests to evaluate a bank's ability to endure financial distress. Internationally, the Basel III regulations were set up to bolster bank liquidity and improve their risk management. These rules require banks to hold a higher ratio of high-quality capital, which is intended to better absorb financial shocks and protect depositors. These measures are designed to build a more resilient banking system and reassure the public that a repeat of the severe banking crises of the past is less likely. Yet, the question persists: how robust are these safeguards? Are they enough to shield us from a potential global banking failure? That's what we'll explore next. Current global banking health, the numbers that tell the story of stability and resilience in the banking sector. This is not just about figures. It's about understanding what these numbers mean for the economy and for you. First up, capital adequacy ratios. These are critical because they measure a bank's capital against its risk-weighted assets. As of the latest reports, major banks in the US have maintained a capital adequacy ratio of 15.2% in March 2024, comfortably above the Basel III requirement of 10.5%. This suggests that American banks are well prepared to absorb financial shocks. In Europe, despite ongoing economic pressures from geopolitical tensions and trade adjustments, banks have reported an average capital adequacy ratio of 19.71%. This is not just good, it's a buffer that builds confidence among consumers and investors alike. Turning to liquidity ratios, which ensure that banks can cover short-term obligations. The latest data indicates that liquidity coverage ratios are holding strong, with many institutions boasting figures upwards of 163% in Europe, where 100% is the minimum threshold. This means that for every dollar of short-term liabilities, these banks have at least $1.63 in easy-to-liquidate assets. However, it's not all positive. The shadow of non-performing assets, NPAs, looms large. In some emerging markets, NPAs have crept up to 5.5% of total assets due to economic slowdowns and sector-specific downturns. This is a key area of concern, as it affects the overall health and lending capacity of banks in these regions. Finally, let's talk about stress tests, which are like a trial by fire for banks. In 2024, the Federal Reserve and the European Central Bank released stress test results that were broadly positive, showing that most banks could withstand a severe recession scenario without breaching critical capital thresholds. These results are vital for understanding how our banks would handle a sudden and severe economic downturn. So, what's the big picture? While banks are generally showing strong indicators of health and stability, the variation in non-performing assets reminds us that vigilance is necessary. The banking sector is robust, but keeping an eye on emerging risks is essential for maintaining this strength. What if all banks were bankrupted? Let's delve into a hypothetical yet startling scenario. All banks globally declare bankruptcy simultaneously. What would this mean in numbers for our personal finances, businesses, governments, and the global economy? We'll break it down using existing data and models. Firstly, the personal finance impact. In the US alone, approximately $11 trillion is held in bank accounts. Imagine waking up to find those funds locked away. The immediate loss of liquidity would halt consumer spending, the primary engine of economic growth, representing nearly 50% of the GDP in economies like the US. For businesses, particularly the small and medium-sized enterprises that rely on daily cash flow and short-term loans, these businesses contribute to 53% of the GDP in countries like the UK and employ a significant portion of the workforce. Without banking services, we could see a failure rate spike, potentially doubling within just a few weeks, leading to massive layoffs and economic contraction. On a macroeconomic scale, consider the stock markets. Banks hold billions in investments, equities, and bonds. Their sudden failure would trigger a sell-off, potentially wiping out up to 30% of market value based on the precedents set during crises like 2008. This would erase trillions in wealth, impacting pensions, retirement savings, and institutional investments worldwide. Government operations would also face paralysis. In countries like Germany, where tax revenue through banks plays a crucial role in funding public services, a banking collapse would jeopardize the government's ability to maintain infrastructure, healthcare, and public safety, threatening societal stability. Globally, international trade relies heavily on banking instruments such as letters of credit and currency exchanges. Over $9 trillion worth of global trade could be at risk if these tools become unavailable, leading to a breakdown in international supply chains and widespread shortages. In response, governments and international bodies like the IMF and World Bank would likely implement emergency liquidity provisions, possibly creating new digital currencies or other instruments to bypass the collapsed banking system. Historical interventions have shown a range of 10 to 20% of the GDP being injected into economies during crises, suggesting a multi-trillion-dollar global response might be necessary. In closing, while this scenario is highly unlikely due to the extensive regulatory frameworks established post-2008, such as the Basel III Accords requiring banks to maintain high liquidity ratios and robust capital buffers, it serves as a stark reminder of our profound reliance on these financial institutions. Ensuring their stability is not just regulatory, but critical for global economic security. Case studies. Let's turn the clock back and explore real-world case studies where banking systems faced severe stresses, from major economies like the US and the EU to smaller ones such as Iceland and Cyprus. But what caused these crises, the interventions that were made, and the lessons learned? Starting with the US, the 2008 financial crisis serves as a monumental study of banking failure. Following the collapse of Lehman Brothers, the US government introduced a $700 billion bailout plan known as the Troubled Asset Relief Program, TARP. This program aimed to stabilize the banking sector by purchasing distressed assets and injecting capital into banks. Despite its controversies, TARP is credited with restoring trust in the banking system and averting a complete economic collapse. Moving across the Atlantic, the EU faced its test during the 2011 debt crisis, particularly in Greece. European banks, laden with sovereign debt, faced severe liquidity shortages. The European Central Bank responded with long-term refinancing operations, LTRO, offering banks low-interest loans to boost liquidity. This move, coupled with fiscal austerity measures, helped stabilize banks but at a high social cost, leading to debates about the balance between financial stability and economic growth. In smaller economies, the situation can be even more precarious. Take Iceland in 2008, whose banking assets at one point were 10 times its GDP. When its major banks failed, Iceland implemented capital controls and let the banks go bankrupt instead of bailing them out, a controversial decision that eventually led to a recovery stronger than many analysts expected. Similarly, Cyprus in 2013 faced a banking crisis that led to an unprecedented measure, a bail-in. This meant that instead of the government bailing out the banks, the depositors had to take a hit, with a significant portion of deposits above €100,000 being seized to recapitalise the banks. This drastic measure was successful in stabilising the banking sector, but at the expense of depositor trust. These cases illustrate a spectrum of strategies, from bailouts and liquidity assistance to letting banks fail and imposing losses on depositors. Each scenario offers unique insights into what measures can stabilise a banking system, what can go wrong, and the delicate balance between safeguarding the economy and protecting the public. Safeguarding your money. In an era of uncertainty, protecting your hard-earned money is more important than ever. One of the simplest ways to safeguard your assets is diversification. Don't keep all your money in one bank. By spreading your funds across multiple institutions, you reduce the risk of losing everything in the rare event of a bank collapse. Additionally, make sure you understand the terms of bank insurance. In the US, the Federal Deposit Insurance Corporation, FDIC, insures deposits up to $250,000 per depositor per bank. If your balance exceeds this, consider moving excess funds to another insured bank. For those outside the US, check your local deposit insurance limits to ensure your money is protected. Staying informed is crucial too. Keep an eye on financial news and updates from trusted sources like central banks or financial regulators. Knowing which institutions are under stress can help you make timely decisions, such as moving your money or opting for safer investment options. Innovative banking alternatives. Traditional banking isn't your only option today. Digital banks are rapidly gaining popularity for their convenience and lower fees. However, these new platforms come with their own risks, particularly regarding regulatory oversight. It's essential to check if your digital bank is FDIC insured or equivalent in your country. Another emerging alternative is cryptocurrency, which offers decentralized financial transactions free from government control. Cryptocurrencies like Bitcoin and Ethereum provide a way to store and transfer value without relying on traditional banks, but they come with high volatility and fewer consumer protections. You could see massive gains or devastating losses, depending on market conditions. Now, I want to hear from you. How do you think a complete banking failure would impact you personally? Have you thought about your financial safety net? Drop your thoughts in the comments, and let's discuss how we can all better protect our assets in these uncertain times. Thinking ahead about where and how you store your money could make all the difference when the unexpected happens. Conclusion. Today, we've dissected the unthinkable, a total collapse of the global banking system. We've travelled through history, examining past crises, and pored over what measures have been put in place to safeguard against such a catastrophic event. Despite the dramatic scenarios discussed, it's crucial to remember that the likelihood of all banks failing simultaneously is extremely low, thanks to stringent regulatory frameworks and rigorous financial safeguards established globally. Understanding where your money is, how it's protected, and what you can do in times of financial uncertainty is more than just good knowledge. It's essential for your financial security. So I encourage you to keep learning, keep questioning, and stay informed. Financial knowledge is a powerful tool. It can save you from panic and protect your future. Don't forget to like, subscribe, and hit the notification bell to stay updated on all our latest content. Thanks for watching, and I'll see you in the next video.